Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are solving Copper Company. This is a past paper question, as you can see, question number 296 from your Kaplan kit, and it has been asked in the March-June 2018 exams. So let's get started with it. Let's first read the requirements before diving into the case study. So using a joint probability table, you have to calculate the mean or the expected NPV of the proposed investment. This is for 8 marks. Then you have to calculate the probability of the investment having a negative NPV for 1 mark. Then you have to calculate the NPV of the most likely outcome for a mark. And then you have to comment on the financial acceptability of the proposed investment for 2 marks. Now, part B requires you to discuss two of the following methods of adjusting for risk and uncertainty in investment appraisal. So all these three, simulation, adjusted payback, risk adjusted discount rates, are nothing but the methods for accounting for risk and uncertainty in your investment appraisal. So you have to discuss any two of them. Now you have 8 marks for this question. That means for each method, you're going to write enough content, enough material such that it has to be written for 4 marks each. So make sure you do that. Now let us read the case study. Copper Company is concerned about the risk associated with the proposed investment and is looking for ways to incorporate risk into its investment appraisal process. The company has heard that probability analysis may be useful in this respect, and so the following information relating to the proposed investment has been prepared. For year 1, you have 3 probabilities. Either it can be 10% that you get $1 million, 50% is the probability that you get $2 million, and 40% is the probability of getting $3 million. Similarly, coming to year 2, you again have 3 sets of probabilities. Either you can get 2 million, the probability of that is 30%, 3 million's probability is 60%, and there's a 10% probability that you get 5 million. However, the company is not sure how to interpret the results of an investment appraisal based on probability analysis. The proposed investment will cost them $3.5 million, payable in full at the start of the first year of operation. Copper Company uses a discount rate of 12% in the investment appraisal process. So let's get started. Let's leave some space for workings in the beginning. Let's first work out the present values of the cash flows. So I can label here that these are my workings, and I'm finding the PVs of cash flows. So for, let it be for year 1. So for year 1, I have 3 cash flow probabilities. I have 3 sorts of cash flows available. Cash flow 1 is given to me as cash flow 1 is a probability of having 1 million. Then I have 2 million. And then I have 3 million. So these are the cash flows that can be there in the first year. Now these are my cash flows, and then I can find out the present value. So present value will be nothing but this cash flow divided by 1.12, because 12% is my discount rate, raising it to the power of 1 because these are for year 1. So these all are my respective cash flows in their present value. So the cash flow, the money that I get a year from now, that money is worth this much money in today's time. So these are our values. Let's do a similar working for year 2 also. So this is for year 2. Let me copy paste this portion here. These are my cash flows. So cash flows, I have 2 million, 3 million, and 5 million. So 2 million is this over here, 3 million is this over here, and 5 million is right here. So for the PV, again, I'll do a similar thing. I'll select this, divide this by 1.12, and raise it to the power of 2, because these are the cash flows which I get after 2 years. So this is what my present value will come out to be for the first year. Similarly, I can drag this down and obtain the values for the rest of the cash flows also. So these are the present values which I have worked out over here. Now let us move to the top and start our solution. This is part A and part I. This is about ENPV. So let's mention over here that this is my expected NPV. So let me label the columns over here. First, let's talk about the years. Then let's take first the PV of year 1 cash flow. Then let's talk about the probability of that happening. Then let's take it for year 2, PV of year 2. Then let's talk about the probability of that. Then let's find out the total PV. And then let's work out the joint probability. Once you multiply your probability 1 with probability 2, then you have your joint probability, and ultimately total PV multiplied by your joint probability will give you your final outcome of this method. So let us first do it for year 1. So if I talk about the PV of cash flow 1. So there are 3 possibilities in year 1 also. So let's go flow wise. So let's go with the first possibility, which was 1 million, and the probability of that happening is 0.1. So I've written 0.1 over here, and present value we have just calculated at the bottom as this figure over here. So now if this happens in the first year, 1 million happens in the first year, there are 3 probabilities for the second year. So let's discuss about that. So second year, 2 million PV, let me take the value from here. This is the value of the PV. And then the probability of this happening is 30%. Similarly, 60% and 10%, we'll take the present values from our workings below. So the present value is this over here. And for the next one, it's this over here. So these are our present values. Now the total PV is going to be nothing but this plus the value of the year 2 probability. Similar formula can be put here also. So this plus this value, and then this plus the cash flow that I have in year 1. So these are my total present values if I add the cash flows for year 1 and year 2. Now the joint probability will be nothing but the product of these two probabilities. First, 10% chance of 1 million happening, then 30% chance of 2 million happening. So what is the chance that both of these will happen? You have to multiply the probabilities together to find out the chance that both will happen together. So 6 multiplied 0.6 multiplied by 0.1 and 0.1 multiplied by 0.1. With this, you have the joint probabilities also available to you. Now, if you how do you calculate the expected NPV? You multiply the present value with the probability. So this is exactly what we are doing over here. With this, we have our PV multiplied by joint probability. Now let's talk about the cash flow 2. So if I talk about cash flow 2 in year 1 is 2 million. So let me first grab the present value from the workings. So this over here is our present value, and the probability also is given to be 50%. So I've input the value for first year now. Now with 2 million, again, these are 3 other possibilities. So let me put all of these outcomes together. The present values will remain the same, as well as the probabilities will remain the same. So I can put equals to, or I can even copy paste the values. So equals to this value over here. This is the present value. And then I put the probabilities also from above. These are my probabilities. Then for total PV also, if I just, okay, I can put in the total PVs. It will be this plus this over here equals to this plus the PV of year 1. And then again, PV of year 2 plus PV of year 1. So these are my total outcomes which I have obtained. Now joint probabilities, again I can copy paste the formula which has been continuing, equals to 0.3 multiplied by 0.5 equals to 0.6 multiplied by 0.5 and equals to 0.1 multiplied by 0.5. So with this I have the joint probabilities. Now I can simply multiply these two together to find out the values. So these over here are what I am getting. Now, if I talk about the PV of cash flow 2, now we are done with 2 cash flows. Now let's move to the third one. So for the third one, there's a 40% chance that 3 million will happen, and the present value of this 3 million is this right over here. Now let us mention the present values of year 2 probabilities. These are nothing but the same figures from here. So you can copy paste them here. Now these are the values. Again, probabilities can also be copy pasted. These remain the same. So I paste this over here. And then for total PV, it's going to be this plus this over here. Similarly, this plus this over here. And then as we are doing it for all of the years, this plus this. So this is your total PV. Now your joint probability becomes 0.3 multiplied by 0.4. For the next one, 0.6 multiplied by 0.4. And for the next one, it's 0.1 multiplied by 0.4. So these are your joint probabilities all worked out. Now you can copy paste the formulas to have your values over here also. Now to find out the expected NPV, the step over here that you have to follow is that you sum all of your PVs. So the sum of PVs, so this is nothing but this value, summing all of the values from over here. So you sum all of these together. Just take the last one also. This is how you sum them up, and then you subtract your initial investment. So your initial investment, that is given as 3.5 millions minus 3500,000. So this is your initial investment over here. You add these two values and then you ultimately get your expected NPV. So this over here is your answer for this 8 marker requirement. Now let us move to the second one, where we have to calculate the probability of the investment having a negative NPV. So let's create one more column over here in our workings which talks about the NPV. So this over here is my total present value, and if I subtract my initial investment, then I will have the NPV. So this minus 3.5 million, this gives me my NPV. So if I just drag this to the bottom, I can see how many outcomes are having over here negative probabilities. So if you see, this is a negative value that I have, this is a negative value, and then 120 is also a negative value. So if you just sum the joint probabilities of these three outcomes together, let me just highlight the ones which have a negative NPV. So these cells over here which are highlighted are having a negative NPV. So just see what are the joint probabilities of this. So it will be this plus this and plus this. So if you see, the sum of these probabilities comes out to be 0.24. So 24% is a probability that you have a negative NPV. You can show over here that probability of negative NPV, and then you can link it through the formula that how so that the examiner knows that how you have found it out. So you take this one plus this one, and then you plus the other one which has a negative value, this over here. This gives you 0.24. If you want, you can also convert it to percentage, that there are 24% there's a chance that you have a negative NPV. Now let's talk about the most likely outcome. Most likely outcome. So most likely outcome is, that outcome which has the most likely, as you can see, the word itself means that something which has the highest probability of happening. What is the, if you probably if you're anticipating your results, so what are the more, what is the marks that you are getting that has the highest probability? So probably if you have calculated your score as, you have done all the calculations that I did this wrong, this was right, this is wrong, this is right. So probably I'm going to get 50% marks. So according to you, 96% you think that you will get 50% marks. So basically what you mean by the most likely outcome is that what what outcome has the highest probability. So if you see the joint probabilities over here, let us find out which outcome is having the highest possible figure over here. So if you see from this, I can see that 0.30, this is 30% probability. All of the others are less. This is 3%, this is 6%, 1%, 15%, 5%, 12%, 24%, and 4%. So this outcome over here, 30% probability, this is the most possible outcome. And in this case, the NPV is 677,295. So the most likely outcome, I can say, equals to this one over here, because this has the highest joint probability. Highest joint probability. Now let's talk about the fourth one, where we have to comment on the financial acceptability of the proposed investment. Now this is worth 2 marks. So what you will do over here is you'll first tell what the decision rule is, and then you will give your own decision that what will happen over here. So if you see that the mean or the expected NPV that we have worked out is positive, so the proposed investment is considered to be financially acceptable. But when we calculate the expected NPV, it is not a value which will definitely be occurring, because this is just a mean, this is just an average. So there is no specific decision rule when it comes to the expected NPV. So you will mention in your comment over here that the decision whether you should consider this project or not should also be based on the probability or the risk. So there is a high risk, if you see 24% risk over here, that you will have a negative NPV. 24% is a high amount of risk. So you will mention that the directors of copper company should definitely consider that there's a 24% chance of having a negative NPV, and hence they should take their decision accordingly. So there is no specific decision rule to be followed over here. This is what your comment will entail. Now let's move to the part B, where we have to discuss 2 of the following methods for adjusting risk and uncertainty. So like I told you, there is only a need to explain only 2. Even if you explain 3, you're not going to get any extra marks. So first, let's talk about simulation. So just to give you an overview, I'm sure you would have studied it. Just to give you an overview, that simulation basically is a way where we are changing more than one variable at a time. We are running scenarios where we are assigning different probabilities to different outcomes happening, and we are also considering that the variables which are there are interrelated. So this is what a simulation basically is. You run a lot of different outcomes which are possible, and then you develop a probability that what is the probability of what outcome happening, and then you work out whether you should be taking the project or not. Talking about adjusted payback, so basically when if risk is increasing, uncertainty is there, so the payback period can be shortened, so that you are considering for the high risk that is there over here. So if you talk about the adjusted payback, you are calculating a payback according to the discount rate. So basically the discount rate can over here act as giving you making you more aware about when you eventually be getting your present value back, the initial investment which you have put in. So this is how adjusted payback helps you in risk and uncertainty. Then if I talk about the risk adjusted discount rates, basically if you bifurcate that what is the risk free rate of return that you are getting, usually the risk free rate of return that we get is the interest rate on FDs. So if you see, FDs will pay you an interest ranging from 3, 4, 5%. This is the usual interest rate that banks pay on FDs. So this is the risk, this is considered as the risk free rate. Now you have to see that what is the risk premium. Premium is any return that you are getting over and above the risk free rate. So you have to determine that what premium should this project specifically give you, so that it becomes worth taking the risk that it entails. So this is how risk adjusted discount rate helps you incorporate risk and uncertainty in your investment appraisal. And the premium, how do you find out how much risk premium should be there? So there's this CAPM model, capital asset pricing model, wherein you identify a company which is working in a similar area where the project which you are taking, similar industry, and then you find out what are the returns that they are making, and then you adjust it according to your company to find out what is the risk premium that this specific project should give you, and then you eventually develop your risk adjusted discount rate. So these are the methods discussed. With this, we have come to an end to this question. I hope that this video was helpful, and please, if you want me to solve any more questions, do let me down in the comments below. Yeah, all right, thank you for watching.